An exchange fund or swap fund allows an investor to exchange or swap stock shares that they already own for shares in the fund. The investor puts in concentrated stock shares, which are pooled with other equities and qualifying assets. When enough shares have been contributed, the fund closes to new investors. Then, each investor is given shares of the exchange fund based on their portion of the original contributions. Over time, any dividends earned by the contributed shares are reinvested in the fund. Why use an exchange fund? With one move, the investor swaps a concentrated stock position for ownership of a diversified portfolio. Because concentrated shares are exchanged for fund shares, no taxable sale occurs, and investors can benefit from tax-deferred growth. Exchange fund units qualify for the same step-up in cost basis as other investments, potentially reducing the tax bill for heirs when they eventually redeem their exchange fund units and sell their distributed shares. Exchange funds tend to appeal to investors, executives, and business owners who have amassed positions centered on one or a handful of companies. Participating in the fund allows them to diversify those heavily concentrated positions of stock while deferring taxes. Interested? Before deciding to invest in an exchange fund, here are just 3 things you should know. First, depending on the fund, minimum investments range from $500,000 to $1 million. Investors are generally required to commit to a minimum holding period of 7 years to realize the potential advantages. Up to 80% of the assets in an exchange fund can be stocks, but the rest must be made up of illiquid investments, such as real estate investments. Of course, there's more, and we're here to help. Reach out to determine if this strategy might be appropriate for your situation and for guidance through the process.